Welcome back to The Capital Flow, the podcast that helps you decode the big economic forces shaping your world. I'm your host, Alex, and today we're tackling something that sounds incredibly dull, but is in fact the most powerful forecasting tool on Wall Street. It's about two key players, the Federal Reserve's interest rates and the U.S. Treasury Yield Curve. Joining me to pull back the curtain on this is financial strategist Ben Carter. Ben, welcome to the show.
Thanks for having me, Alex. It's great to be here. This is a crucial conversation because, as you mentioned, these concepts might seem distant, but they directly affect everything from your mortgage rate to the price of gasoline.
Right. Let's start with the context. Why does a two-day meeting in Washington, D.C., the Federal Reserve meeting, suddenly change the cost of a business loan or, as you said, the price of gasoline for someone living in, say, Brazil?
That's the invisible link, isn't it? The Fed, as the central bank of the U.S., has this dual mandate: keep employment high and keep prices stable, meaning low inflation. Their primary weapon is the federal funds rate. Think of the economy like a garden, and this rate is the valve controlling the water hose.
The water hose metaphor, I like that.
Exactly. If the economy is overheating and you have high inflation, the Fed raises rates, turns the valve off. This makes borrowing money for banks, for businesses, for you on your credit card much more expensive.
Money gets costly, people spend less, and demand cools. Conversely, if the economy is wilting in a recession, they lower rates, open the valve to make credit cheap and encourage spending.
So that's the rates, the engine of the ship. But how does that engine directly connect to the ship itself, which is the USD?
That's where the concept of the dollar as a global magnet for capital comes in. When the Fed raises rates, U.S. government bonds and other dollar-denominated assets suddenly offer a much higher return, often considered risk-free.
Meaning, if I'm an investor in Japan or Europe, I look at the US and see a great, safe yield.
Precisely. You see a higher yield on your investment. To buy those bonds, you must buy dollars. This massive, coordinated global demand for the dollar and the foreign exchange market strengthens the currency. It becomes more valuable compared to the euro, the yen, or local emerging market currencies. High rates, strong dollar.
The yield curve, the profit.
That makes perfect sense. The dollar follows the rates. But now let's introduce the profit, the one that tells us if the hurricane is coming, the U.S. Treasury Yield Curve. What is it, and why do Wall Street analysts treat it like a crystal ball?
The yield curve is essentially the bond market's forecast of the future. It's a graph showing the interest rates or yields you get from U.S. Treasury bonds over different time spans, from 3 months up to 30 years.
And normally, the longer I lend my money out, the higher the interest I demand, right?
Right. That's the logic of reward. Lending money for 10 years is riskier than lending it for 3 months. You demand a risk premium. So a normal curve slopes upward. Long-term rates are higher than short-term rates. That's a healthy economy.
But we often hear the scary term curve inversion, when short-term rates are higher than long-term rates. Why is that such a big deal?
An inversion is a highly anomalous, flashing red light. It's the market saying, wait a minute, we think the future is riskier than the present. It signals that investors have lost faith in long-term growth and are anticipating an imminent recession.
But why would long-term rates fall if a recession is coming? Wouldn't risk go up?
It's driven by 2 factors. First, the Fed aggressively raises short-term rates to fight inflation, making those one-year bonds look great. And second, the long-term investors, pension funds, big banks, they look ahead and they know these high rates are going to trigger a recession. They predict the Fed will have to drastically cut rates in the future to stimulate the economy again.
So they are buying up long-term bonds now, thinking the rate I lock in today will look amazing when the Fed cuts rates to 0 later.
Exactly. That demand for the safety and the guaranteed rate of the long-term bond pushes the yield down, causing the inversion. It's this historical, infallible predictor. Since 1955, every single U.S. recession has been preceded by an inverted curve. Every single one.
Wow, that's powerful. But there's often a delay, right? It's not an immediate panic button.
No, not at all. It's a warning, not an execution notice. There's typically a lapse of 6 to 24 months between the initial inversion and the start of the recession. That time is precious. It allows you to review your risk exposure and restructure your portfolio.
Psychological insights and practical application. Let's talk about the emotional and psychological side because investing isn't always rational. If the curve is inverted, how does that anxiety affect the dollar's value?
That's a great point. The dollar's relationship with the curve is a two-act play. Act 1, flattening or start of inversion, the Fed is hiking rates aggressively. The dollar is very strong because it's high-yielding bait for global capital. People pile into short-term dollar assets. The mood is nervous, but the currency is booming.
So the dollar acts as a high-yielding safe haven during this initial phase of anxiety.
Yes. But then comes Act 2, deep inversion or recession approaches. The mood shifts from anxious to certain. The market knows the recession is inevitable. They anticipate the Fed's U-turn, the Fed pivot, where they start cutting rates. Investors don't wait. They start selling dollars and moving into assets that do well when rates are low, like gold or safer currencies like the Swiss franc or Japanese yen.
The dollar's magnet loses its strength. That shift from dollar strength to dollar weakness is crucial for international investors.
It is. Imagine a coffee farmer we mentioned earlier. When the dollar is strong, the farmer gets more local currency for their coffee. That sounds great initially, but if that dollar strength persists, the American buyer might start reducing demand or seeking cheaper sources elsewhere. Dollar strength is a double-edged sword for global trade.
So, for our listeners, what's the actionable takeaway here? How do they use this information?
We can break it down into a simple table of action. If the curve is normal, upward slope, economic expansion is expected. This is the time for greater exposure to growth assets and cyclical stocks. If the curve is flattening, short rates are rising fast, the Fed is restrictive, the dollar is strong. Increase your cash positions in USD, but start looking at defensive assets. If the curve is inverted, a recession is likely within the next year or two. Reduce your risk in your stock portfolio, move capital into safe haven assets like gold, and prepare for the eventual Fed rate cutting cycle and dollar weakness.
That's clear guidance. Diversification is key, right? Don't bet everything on a single currency.
Absolutely. Monetary policy is a global game of chess. The Fed moves one piece, the rates, the dollar reacts, and the yield curve shows us the possible endgame. Having this knowledge moves you from a passive spectator to an active strategist.
Conclusion. Ben, this has been an incredibly insightful discussion, transforming these complex ideas into a usable map for our listeners. To quickly summarize, the three essential truths are: the Fed is the master, their rates drive the dollar's strength. The curve is the prophet, its inversion is a near-infallible recession signal. And finally, the dollar follows the cycle. It gets strong during rate hikes and weakens when the Fed is forced to cut rates.
Exactly, Alex. Financial education isn't about memorizing acronyms. It's about understanding these cycles and causes. The yield curve provides that clarity, that confidence.
Ben Carter, thank you for sharing your expertise with us today.
My pleasure, Alex.
And to our listeners, don't let this knowledge fade away. Take a look at the current shape of the yield curve right now. Are you positioned for a strong or weak dollar in the next 12 months? We'll see you next time on The Capital Flow.